Morning, everybody, and welcome. As I said, my name is Steve Philp, and I'm the director at Portugal Pathways and your host for today's webinar. Today, we're discussing a topic that's of major importance for UK expats living in Portugal, and the proposed inheritance tax change is expected to come into effect in April 2025, as well as the impact on the UK pensions from the recent UK government budget. Our panelists today will be taking questions throughout the 45-minute webinar, so we obviously encourage you to leave any questions and any comments in the chat. If we do go over the 45 minutes today and you guys have to leave, be reassured that we are recording today's session, and that recording will be sent out to you within the next 24 hours, along with obviously summary notes as well. Again, going back to the questions, if we don't manage to get to all of them today, our team will be reaching out to you to arrange a discovery call with one of our panelist experts in inheritance tax and cross-border structuring of income and assets. Obviously, that includes pensions, so that will be going out as well. We'll also be discussing Portugal's NHR tax regime and what is set to replace it, and how to plan early to ensure peace of mind and optimization of your estate and income. Before we get going, obviously, I'd like to introduce you to your panel today. Firstly, we have Niall McDonald. Niall is a partner and wealth manager at Beacon Global Wealth Management, and he specializes in cross-border financial planning. Niall helps expats optimize their tax and investment strategies. We also have Chris Marsden. Chris is the managing director at Beacon Global Wealth Management. He has decades of experience advising ultra-high net worth families. Chris focuses on wealth structuring and international tax compliance. And finally, we have Paul Stannard. Paul is the chairman and founder of Portugal Pathways and the Portugal Investment Owners Club. So welcome, Chris, Paul, and Niall. Thank you for joining us today. So we're going to begin today's discussion with the key question, and I'm going to ask Niall to answer this first, and then Chris to come in behind him. So the key question is, what are the significant aspects of the UK inheritance tax rules? As I said, let's start with Niall, and then Chris, you can come in behind.
So hi, good morning, everyone, and thank you, Steve, for the introduction. Currently in Portugal. I think the rest of the people on the panel here are mostly in the UK, and I'd be delighted to say it's sunny. It's not so much this morning, but no doubt it will pick up later in the afternoon. But on the question, I think it's firstly important to understand again what inheritance tax is, the impact that it can have, certainly on families, and also understanding some of the things regards domicile and deemed domicile, which can all be fairly complex and can be specific to each individual. But to recap roughly then on inheritance tax, effectively it's a tax on the deceased's estate. So the UK has some allowances that are available for the deceased's estate. The main one being the nil rate band of £325,000, and indeed this is set to stay in place until 2030 at the earliest. So it has been around that number for quite considerable time. A lot of wealth has increased over that period, but unfortunately the nil rate band has stayed constant at that number. It's considered a bit of a stealth tax in that regard, but yeah, it's certainly stayed at that number. There has been a few other allowances which can be applied and can certainly help to increase the allowance available on the estate. Again, the main one being the main residence nil rate band, which is set at £175,000 per person. So in total, it would give you £500,000 of an estate value, which you would then be able to pass on. There are other things and certainly important considerations regards spousal transfers, which are again currently exempt, and ensuring that you sort of leave any main residence to direct descendants to then benefit from these additional allowances. But if we, can assume a 500,000 allowance and indeed a 1 million allowance for a couple. Regards domicile, that's a very complex area, but typically it's down to where you would classify as your home. It can also include things such as the number of tax years that you've been based in certain jurisdictions, even down to where your father was born. But as I say, it can be quite complex and quite difficult. The UK has a fairly strong grasp of the domicile situation, and it can be quite difficult to remove that, certainly from a UK citizen perspective. So that's just a little recap on the current IHT and the current domicile rules. But what's changing in effect from April 25 is something that most of us really didn't expect, and that it's changing from a domicile basis to what's known as a long-term residency based system. It kind of mirrors a little bit more some of the other systems that we see around the world, but effectively what it means is now your tax liabilities will be determined where the individual resides rather than per se where they are domiciled. As I say, it kind of caught us out a little bit. We weren't expecting that. I sort of suspect the intention was aimed at capturing the sort of non-doms within the UK, but the kind of unintended consequence that the government, I suspect, has created is it's opened up opportunities for non-UK residents, or in other words, expats. And indeed, that's what the purpose of my conversation will be around today, really exploring what those opportunities are and how some of the people on the webinar today may be able to benefit from that.
Thank you. Chris, anything to come in behind sort of Niall on that?
Yeah, I think we've got some slides to put up, Steve, haven't we?
I think, I mean, I can put those up now. I could have them to come up a bit later in the conversation. So which slides would you like, Chris? The inheritance ones or the case study?
No, I think the inheritance ones, just so that we talk about what's changed, what's happened, because this is an absolutely enormous change for UK expats. It gives them the opportunity to really avoid UK IHT, which, when you think that's 40% of your assets, is a huge number. If you've got a property in Portugal, you're living in Portugal, all of a sudden, as from April this year, 40% of the value of your villa is now no longer going to the UK government if you reach these non-residency rules, which is basically if you're outside of the UK for 10 of the last 20 years. And I really can't state what Niall just said. I think this is an unintended consequence by the UK government, and it gives us a real opportunity to have certainty of planning in what they do. Anybody that's thinking of moving out of the UK, anybody that's actually outside the UK, I would say act now while these rules are in place, because they do give you a real opportunity to tax plan. We've all been reading about how many people are leaving the UK. I think it was it a millionaire's leaving every 45 minutes or something since the budget, and so that actually gives us a feeling of this is what people are doing. So from the point of view of where Niall's going and what we can talk about and talk through today, it's vital that we understand and get to grips with the current the legislation as it's meant to be.
Okay, Chris. Thank you very much for that. Just obviously moving the sort of question on a bit. Obviously, this is a significant, especially as it's moving from, like you said, a domicile-based rules to a residency rule. And that has seemed to open up significant opportunities for expats to take advantage quickly. Niall, what steps can expats take now to ensure that they're well prepared? And what are the best strategies or options for people?
Sure. Yeah, I guess the first thing I always would say, certainly this question, which would be relevant to the discussion here, is to understand where your current assets are, where they reside. So we see quite a range of clients come to us from the UK, from the US, South Africa, I guess most English-speaking countries, and really some of the people, they've moved around a lot, so their assets are based in different jurisdictions. So I'd say the first thing is to understand where their assets are located, what they are, so what structures they're based on, and then what taxes those assets would be exposed to. Probably the second thing is to look at where the individuals located themselves. Again, there's some specific things regarding other countries, but if we're dealing with the UK, then that's a fairly straight one to answer. But believe it or not, it gets a little bit more complicated when you include things such as the number of days and whether you are, deemed to be tax resident, depending on the number of days that you spend either in Europe or in the UK, if you have the visas or not the visas, then there's some fairly complex stuff that can go in there. And then also looking at what the plans are for the client for the next sort of 5 to 10 years, so that we can put a structure in place that looks to try and optimize the tax strategy based on where the individual is, based on where the asset is, and obviously, of course, looking at trying to grow the investment. So it probably won't come as a surprise to you that the answer for me is always going to be to try and make an appointment to meet with someone. I'd love to be able to give you like a straightforward answer on that, but it actually really is quite specific. Certainly when you look at cross-border situations, it's probably vitally more important to have a relationship with someone that you can sort of work with and look through the various different sort of assets and where they're based. So I'd say the first thing, gain an asset list, look at the jurisdictions, also where you've been, and then we can certainly take it from there to look at what the best strategy going forward would be.
Lovely. Thank you. I think I'm one of my colleagues who's just put a link up just to, if you do want to sort of discover this and get under the bonnet a little bit more with Niall, please obviously contact us and we'll get that arranged for you. Chris, just before we sort of move on to Paul, anything else that you want to add on that in terms of sort of strategies and options?
Yeah, I think as Niall said, the strategy has to be right for the individual. I mean, it's okay moving outside the UK. Saying we'll move outside the UK for inheritance tax, but it has to work for you and your family. It has to work for your lifestyle. But I think one of the key things to look at is to plan early. It's like everything. Meet with someone, plan early. Find someone that you trust, but the key bit to it is understand what the opportunity is at the moment. I mean, everything's subject to change, and this 10-year non-residency rule. I mean, it is, and I can't stress out what an amazing opportunity it is as things stand. So it's like everything in life. Plan early and make sure that I guess what I'm saying, make sure that what you do fits in with your lifestyle and how you want to live. But there are significant tax savings to be made by moving outside the UK, or if you've been in Portugal for a length of time, by making sure that you plan your assets and your structures around what you want to achieve.
Brilliant. Thank you, Paul. I know that obviously we've seen a lot of activity and inquiries from the UK, obviously since the budget came in from the Labour government. Can you give us your insight into what some of these affluent UK families are saying?
Yeah, I mean, it's not just that families. I mean, I was on a call last week with a family, but they're an entrepreneurial family. They've got 3 different businesses. The father's got a business, holding company. The 2 sons have got sizable businesses, and going on what Chris was saying earlier, in their particular situation, they were thinking of coming to Portugal anyway, and we helped them get a golden visa and what have you. But they were shocked to their boots that suddenly it wasn't just the hit on inheritance tax. They were worried about the capital gains when they sell their business. So this sort of fear of the UK government being the biggest beneficiary of your estate, is quite frightening to some, and our inbox has been, lit up with it. We were quoted in that article in the Financial Times just before Christmas that highlighted this, and then it subsequently was then followed up in Portugal News, and we've had literally hundreds of British expats in Portugal, and it's not just Portugal. There's 3.5 million expats around the world that can benefit from this, and moving from domicile to a residency-based system, as Chris said, it opens up a huge opportunity. And the fact, we had a lot of expats in Portugal that had moved assets into structures, whether it was insurance bonds or whatever their chosen path was, but sometimes they'd leave their UK pension in the UK. But that's not happening now. We're suddenly getting inundated with people saying if they're going to include our pension pot in our overall inheritance pot, then we don't just want our pension out, we want to look at our whole portfolio, because property market's not really moving in the UK, it is in Portugal. So there are many, many different reasons why people would do this now. And Portugal, let's be honest, is actually outperforming the Eurozone. It's outperforming the UK. Its inflation is decreasing faster than the rest of Europe. So it's in a good spot. So yeah, that's what we're seeing.
Absolutely. Well, you touched on a very important opportunity there. Obviously, you mentioned pensions. So, Niall, could you explain to the audience a little bit more about what this means for families with UK-based pensions and or obviously mixed assets?
Sure. Yeah. I'm happy to pick that one up. So, as is sort of currently, and most people will be aware, I'm sure, that pensions currently reside outside of the person's estate, down to predominantly being a trust-based arrangement. So pensions would be considered outside of the estate, therefore not captured directly by any inheritance tax. Again, one of the changes from the recent budget is then proposed to be that from April 27, pensions will actually be incorporated within the estate of the person or the owner of the asset. Pensions, typically have always been a source of funding, mostly, pension being retirement planning vehicle. But it's also been a very, very effective use for shielding and impacting any inheritance tax implications. But with those changes coming in April 27, from an inheritance tax perspective, it doesn't work. So the key thing really there being, again, with the move to the residency-based style, it opens up an opportunity for UK expats that have the number of years outside of the UK, the sort of magic number being 10, to look at ways in which they may be able to utilise that asset a little bit better for them. In other words, taking it out of the sort of inheritance tax equation entirely. Now that's a fairly easy, straightforward thing to say, but again, in practice, there's issues around that with regards to where the person is currently based, what the taxation environment is for that person relatable to that UK asset. But again, going back to the UK inheritance tax situation, because that asset will be based in the UK, if it's the pension, then it's always going to be subject to UK inheritance tax. So what you really want to do is try and remove it from, or break it from the UK asset structure, and look at sort of an offshore based structure as well. you can certainly keep the value of it intact, but it's sort of shielding it from the inheritance tax position of it. So previously, again, as Paul was mentioning, pension has always been something that predominantly the clients wanted to keep hold of. Again, that can filter into lifestyle options and various other things around that. But now with the changes, certainly proposed from April 27, and with the residency-based changes, the argument for stripping the pension has never been sort of higher than what it would be now. Indeed, it's a lot of the work that we're doing with some of the clients that we have is to look at ways in which we can do that sort of optimally and in the most tax efficient manner.
Great. Thank you, Niall. I mean, obviously we're talking a lot today. It'd be really good to get some sort of meat on the bones, and what better way than maybe through a case study. And Chris, I know we've got a case study for you to talk to now, which obviously will help our audience to sort of picture this opportunity a little bit better. So give me 2 seconds and I'll bring that up for you to talk to, Chris. Here we go.
No problem at all. Okay, so this is a real life client, someone we're working with currently. They've been a long-term resident in Portugal, no longer UK resident. What they have is they've kept a house in the UK worth £1 million. They got £200,000 in their ISAs, and they've got other assets. So in there, we've included their pension funds and their other savings assets. They've also owned a house in Portugal, and they've got £500,000 sitting in a Portuguese investment structure that we've put together for them to fund their lifestyle post non-habitual residency, so post NHR. They've been in Portugal for about six and a half years, I think. So in total, they got 3.2 million in assets. Now, what we need to look at there are where these assets are based and how they would be taxed when they have been in Portugal for 10 years, and what the new structures look like in the UK. So Steve, if you move on to the next slide, it will give us some. So currently where we are, pre-April 2025, they've got the UK, what we call UK domicile, so that it means that they're taxed on their worldwide assets. So it means that all their assets are taken into account. They've got a liability of just over £1 million. You can see there, and these are really quite scary numbers. And I always, when I talk to clients, it's like having a loan from the inheritance tax. One of the ways I describe it to clients is like having a loan from the government of 40% of your total assets, which is repayable on death. So that's a really big thing if you think of it like that. And now they're coming to now your pension fund is coming into the inheritance tax net. That causes even more problems, because that will increase the value of your estate. And why is that important? Well, if you increase the value of your estate, what it means is you start losing the residence nil rate band that Niall was talking about. So that 175,000 that each husband and wife have that they can pass down if they pass their house to children or grandchildren. Post April 2025, if the assets haven't been moved, Edward would still have a tax liability on those assets that are left in the UK. If we assume that he's been outside for 10 years, those assets that are based in the UK, so probably his pension assets, his ISA assets, his house, those types of things, you would be paying 40% IHT less your reliefs on that, and that would be a £280,000 bill, which is still a considerable amount of money. It's not £1 million, so there's savings, significant savings to be had. What we're working with Edward on is moving those assets outside the UK. So because he's on NHR, it's very tax efficient to draw down his pension income, his pension, to place it into a structure that's much more Portuguese compliant. So we can withdraw all of that pension money. So that comes down to zero. We're selling the ISA and the property assets in the UK, because actually, if you've got £1 million property, all that's doing is giving you a £400,000 liability. Whereas you can take that £1 million out, you sell that property, and use your principal private residence relief or pay some small amount of capital gains tax if you've not been outside the UK long enough. But luckily, we're able to get that out tax-free for Edward and place it into structures in Portugal. So you can see there are 3 different scenarios. Current scenario post 2025, April 2025, when he leaves assets in the UK, and post April 2025 when you take your assets out the UK. And there's a reducing amount of inheritance tax due every time. These opportunities for people to move outside the UK and avoid IHT really are one of the biggest opportunities for people I've been working with wealthy people planning and structuring their affairs since 1987. So that's a long time. That's a long time. I'm very old. But this is the greatest opportunity I've seen, and to be honest, it's also the greatest flow of wealth that I've seen in the last 40 years.
Absolutely, Chris. Like you said, it's a huge opportunity. Niall, anything that you want to sort of add to what Chris has said around these sort of slides and case
Sure.
studies?
I think Chris has kind of covered the key points there. I think the slides are very, very self-explanatory, whereby, currently on the left-hand side, you've got as things stand at the moment, with a total worldwide assets subject to inheritance tax, April 25, which isn't far away now. Due to these changes, there's going to be some benefits attached to that. But certainly, if you look at the right-hand side, there's an opportunity if you are non-UK long-term resident to take your assets outside of the UK and really benefit from it in its entirety. So, certainly to echo what Chris was saying, I think it's a great opportunity for those people that would qualify as such, and it'd be silly not to consider it, really.
Absolutely. Well, I mean, that's really interesting. I think the message that's coming through is that it's a great opportunity, and ultimately the earlier you take action, the better. I think that's the message that you guys are looking to get across. So again, Chris and Niall, could you sort of expand on what expats who are interested in investing in Portuguese property, for instance, over UK property portfolios, based on these changes in Portugal and the wider scope? I mean, how does this sort of tie into inheritance, estate and tax planning, and what advice would you give on that?
Do you want me to take that one, Chris?
Yeah, you go.
Yeah. I can start.
Yeah, happy to.
Sure. If we're talking about direct holdings, so the direct individual holding the property, which is a bit easier to discuss, but UK property or UK-based assets will always be subject to UK inheritance tax. So the UK property will always be subject to UK taxes, in effect. So it doesn't matter if the person has been living outside of the UK or is indeed considered a long-term, non-long-term UK resident, and that asset will always then be subject to the UK tax system. Of course, we've talked a little bit about some allowances. So yes, there are allowances available, but it depends on the number, depends on the value of the property. You've got capital gains to consider, you've got income tax if you are renting it out to consider, but certainly again, the purpose of this would be the inheritance tax. Now that's always going to be subject to UK inheritance tax. If the client owns a property in Portugal, then there is no inheritance tax. So it doesn't exist here. There is something, however, called stamp duty, which is slightly different to what we would maybe know it as in the UK, which is at 10%. However, due to the sort of heirship rules that they have here in Portugal, if that is left to, again, an immediate family member, so whether it's a spouse or parents or children, grandchildren, then it's effectively waived. So in terms of an inheritance tax environment situation, it can't be better than nothing. And certainly that's what Portugal's exposure is to it, whereas the UK, that UK asset will be exposed to UK inheritance tax. So it's a much more tax-friendly estate planning environment to have your assets here rather than it would be currently in the UK.
Thanks, Niall. Chris, anything in terms of coming behind what Niall said on that?
Yeah, I think the opportunities that are being presented from the government at the moment, as I say, are incredible, and it relies on being outside of the UK. I can see some questions in our chat about what's a non-dom, what's a dom, what's what all these phrases that we in the industry use. Effectively, what we're moving to is a residency-based IHT system, which means if you've been outside the UK for 10 of the last 20 years, you won't pay UK inheritance tax on any non-UK situs assets. So the question around Portuguese property, if you want to stay in the UK property market because you believe it's going to outperform other property markets, please remember that what you will be doing is you'll be subjecting yourself to 40% of that growth on inheritance tax. So it's really got to outperform any other assets that you have. So what's important actually is you never let the tax tail wag the investment dog. That's a phrase that you'll hear all the way through the financial services industry. But actually, if 40% of your growth is being taken away in taxation, you've really got to outperform to do well. And what we try to do with our clients is we'll sit down and we'll build a portfolio across various assets that will take into account their risk profile on investment. So it will include real estate, it'll include cash, it'll include stocks, shares, government gilts, income producing assets. And then we'll look at how do we make that the most tax efficient for them in Portugal. So, the answer to your question is, I don't know which real estate market will do better. I don't know if BP will perform better than Shell. What I do know is that if you're subject to a 40% tax on your investments, you got to do really well to if you can avoid that, you got to do really well to beat that.
Absolutely. Yeah, I think that was really succinctly put, Chris. Thank you. I'd also I'd like to ask, as I'm sure some of the people watching this might be interested in this as well, what is the process for moving investments or pensions out of the UK to mitigate inheritance tax liabilities? Again, I don't know if Chris or Niall, you want to sort of take that one on for me?
Yep, mine's probably going to be quite succinct, so Chris can probably pad it around a little. In terms of the process, really, to do some planning at the front end, so to understand what the taxes are that you're liable to, depending on what that asset is, understanding the forms and the reporting standards that needed. So again, if we want to talk specifically about the UK, then we would work with their UK accountant or their Portuguese accountant so that we can tie in the relevant forms so that they're all completed correctly and succinctly in time before we then start moving the assets around. So we know what the impact is going to be before we start doing it. So it is important that we work with some of the other professionals either that they have or indeed connections that we also have. And it's a bit of an obvious one, but then it's to understand what to do with the proceeds of the sale. So if you're selling your UK property and it's worth $1 million, why are we selling it? What are the taxes? And what are we going to do with that money? And that really, in effect, is what I try and help people with when they are certainly moving from the UK over here to Portugal, is to go through that process with them so that they understand the different consequences of doing so. So maybe that's a little more succinct than you would like, but yeah, it's probably as straightforward as I can make it.
Chris, any sort of any flavour to add to that?
Yeah, I mean, it is as Niall said, it's a relatively simple process moving assets from the UK to Portugal. None of this is stuff that we're not doing all of the time. So I think when we talk to clients, the biggest issue is just generally that bit of getting your head around why you're selling a UK property. Why are you selling your ISAs? Why are you emptying your pensions? Because in our heads, pensions are there for our long-term retirement planning. ISAs are tax-free, but they're only income and growth tax-free in the UK. They're subject to inheritance tax. pensions are now subject to inheritance tax. So actually, it's much more of a cultural thing, I guess, is that people think that they should have some assets in the UK. But once you've made the move to Portugal and you're living in Portugal, if you've watched any of these webinars and heard me talk before, you've got to think Portuguese.
Mm-hmm.
You've got to act like you're Portuguese. You've got to plan like you're Portuguese. And that's what Niall and I do for our clients.
Brilliant. Thank you, Chris. Thank you, Chris. Paul, we haven't heard from you for a while, so I don't feel that you feel forgotten. But I know that we've held a lot of events in the UK and in Portugal over the last sort of 3 or 4 months for investors and potential members for our new Portugal Investment Owners Club. What's the sort of general understanding for most people?
Well, I mean, there's been a fear prior to the budget. There was a fear of what was going to happen with taxes generally. But the other thing that's been going on in the background, Portugal has brought its sort of its old NHR tax regime to an end, new entrants at the end of December this year, but has now introduced this new NHR 2.0 tax regime, which is very friendly to wealth creators and entrepreneurs and people in high skilled professions. And past performance isn't a replication of what future performance would be. But one thing I would see, all the indicators are showing that Portugal, because so much capital is going there, not just from the UK, from the US, Canada, South Africa, Asia, that there's a pent-up demand, and investor confidence in Portugal has never been higher. So whilst I know Chris is saying, you can't say whether BP or Shell is the best one to put your bet on, currently at the moment, all the indicators are showing that Portugal is a secure and safe place to invest, particularly in the luxury property market, particularly in the Golden Visa investment program, and bonds, insurance bonds, which a lot of people move their pensions from the UK into insurance wrappers, because that's the most common process. Is growing, and that's what we're seeing. There's a big wall of money that wants to find a home in Portugal.
Absolutely, yeah. That's Thank you for that, Paul. I'm just looking at the time and looking at the questions that are coming in. As I said, if we don't get a chance to get round to answering everybody's questions today, we will come back to you. We will be communicating with you and seeing obviously how we can help moving forward. This sort of next question I think is quite interesting, and I'm going to put this to Chris. What would happen if someone then plans to return to the UK in the future?
Okay, yeah, that's a very good question actually, because let's assume that someone has done their 10 years, they're outside the UK, and they've planned where they are. Once you return to the UK, you still have, the residency test at the moment is 10 out of the last 20 years. So let's say you'd lived in Portugal for 10 years and you move back to the UK for the next 10 years, you are still outside of the UK inheritance tax net as things stand currently. And that means that on any non-UK assets, so that's very important. So if you buy a house in the UK, that would be subject to UK inheritance tax because that's a UK asset. But if you come back, you still have 10 years where you're outside of the UK inheritance tax net.
Understand? Yeah, absolutely. That makes perfect sense. Perfect sense. Now, I'm going to sort of move us on a little bit and start looking at some of these questions that are coming in from the audience. So we have a question here from Emma. She's asking, how does a domicile to residency rules affect me, as I have been living in the UK as a UK expat for 5 years? Chris, do you want to sort of take that one for me, please?
Yeah. Sorry, was that the one from Emma? You say
the one from Emma? Yeah.
Yeah, how does the domicile to residency rules affect me? As I've been living in Portugal as a UK expat for 5 years.
That's
so
right.
Domicile is based on a very strange structuring, and generally most people it's where you're born, or if you can take the domicile of your father, not your mother, but of your father. So we can see how out of date these kind of rules are. The change will mean, Emma, that if you've been outside the UK for 5 years, once you've been outside for 10 years, you will no longer be liable to UK inheritance tax on your assets that are non-UK based. And so what it means is you have an opportunity now where you never had it before to avoid UK IHT. And I can't stress that enough. Anybody that's outside the UK for 10 years has an opportunity that they would never have had before.
Absolutely, yeah, huge opportunity. And again, we can't reiterate enough, the earlier that you act, the better it will be. Question here from David. Again, he's an expat living in the Algarve. And David is asking, I live in the Algarve and I want to know what the process for moving investments out of the UK to stop the UK government from being the main beneficiary of my pension and other property assets in the UK. Niall, do you want to have an answer to that one, please?
Sure. Yeah. In terms of David's question, again, it's probably important to meet to understand what those assets, exactly are. I know you mentioned that there's a pension, potentially a property as well. So it'd be a case of working through what the option available to sell down those assets look like, ensuring that they have the right tax structures in place so that when they are sold, they potentially aren't subject to any more tax than they should be, and then looking at what the proceeds to do with that sale are, depending on what David's plans are again for sort of next 5-10 years, whether he has the non-habitual residency or if he doesn't, what structures are in play for David really. So the important thing really would be to get a better understanding of what David's situation is, and then really advise accordingly.
Absolutely, yes. So David, if you haven't already, obviously please reach out to us and we'll connect you with Niall, and he can obviously go into more detail with you at a meeting. So again, looking at the questions, Niall, I'm going to stay with you on this one. This one's from Sophia. She's asking, she's saying that she's got a very large pension pot in the UK, along with a business that she could run from anywhere. She was considering moving to an insurance wrapper for when her NHR tax status in Portugal ends in 7 years' time. And she's asking, should she be speeding up this process, and ultimately what are the likely outcomes and benefits?
Yes. But again, it's important really to understand why, what, and where. Everything that you've mentioned to me with regards to what she's considering sounds on the face of it like the right approach, but each individual has their own differences, has their own lifestyle options, so it's making sure that whatever the end structure is for those assets is right for that person. But yes, fundamentally, everything that we're talking about today with regards to inheritance tax, if that's the name of the game, then the answer is get your asset out of the UK. Right. It can't be any more straightforward than that. What you do with it when you're here is something that we can certainly talk to you about.
Absolutely. And Sophia, but very much like David, if you haven't reached out to us, please do so. And as I said, we will get you in front of Niall, and he will do sort of a deep dive and obviously sort of feedback in line with your specific sort of circumstances. I've got a couple more questions before we sort of look to wrap up, and we've managed to sort of keep it within the time frame, which is good, because I know the panelists and of course the audience themselves have got a busy day ahead of them. So this is another interesting question actually from Mary. I want to go to Chris on this one, and Mary's saying, what are the specific financial products that can support me in not allowing the UK government to take my children's inheritance?
I mean, there aren't any particular products per se. I mean, if you're in Portugal, you know, there are structures and products that will help make it tax efficient in Portugal. But with the new IHT regime, the key bit is, as Niall has just said, is making sure you don't have UK assets and making sure that you're outside of the UK and obey by the residency rules. So, you know, sitting down with Niall and ourselves, we can make sure that you fit those residency rules. We can make sure that when you're in Portugal, you've got the most tax efficient means of getting your income. You know, there are other things that can be done around UK inheritance tax. Niall's a regulated FCA advisor, so he can sit down and talk through those with you. My colleague David's a regulated FCA advisor, so he can talk about that. So having people that understand Portugal and people that understand the UK is really important. Really, really important. You know, I'm regulated to do business in the UK too, but you know, we have people that understand your situation. We have people that sit there and rather than saying you should use this product or this solution, actually it's, and I'm not a great fan of the phrase, but it's the holistic solution that you have to look at. You know, you have to look at the whole, and that's exactly what a good advisor will do with you.
Absolutely. And again, we just got a question from Olivia, and she's asking how quickly can she arrange a meeting with either yourself, Chris, or Niall to discuss obviously their situation. Olivia, obviously, you know, reach out to us and we will put you in direct contact with Niall and Chris, and they will arrange either a face-to-face meeting with you if you're in Portugal and it's convenient for you, or if indeed a video call is better for you, they can do that. And again, all fitting around your schedule. So again, you know, reach out to us and we will arrange that really quickly for you. Let's sort of just take one last question and before we sort of wrap everything up. And this one's from Charlotte, and she's saying, and how can I manage the tax implications of gift assets to my children whilst living abroad? Niall, do you want to sort of take that last question for me, please?
Yeah, sure. I'll give it a go. Just on some meetings and stuff. If people are, you know, based in the UK, I'm fairly regularly back in the UK, so you know, something we can do also. You know, we can fly in to London or Glasgow or Manchester, Edinburgh, wherever the person's based, and we can always meet with them there as well. We are based in Portugal, but fairly back in the UK, so can always meet there. On the question, again, it depends on the residency of the individual. I'm going to now assume these new rules for the purpose of answering it, and the location of the asset. So if the individual continues to be a UK resident, then it's going to be subject to the potential exempt transfer, again, depending on what that particular asset is and how and where they're transferring it to, but it's going to be subject to the 7-year regulation period. Whereas if they're non-UK resident, then there is a potential that the asset could be gifted immediately and outside of the IHT sphere. But that is quite a specific question, and the best answer I could give would really depend on getting a little bit more understanding of what that person's asset is and why they're trying to do it to make sure I give them the best recommendation.
Brilliant. Thank you. I obviously acknowledge the fact that we've gone slightly over, so I do apologise. As I said, if we haven't got round to all of your questions today, which quite clearly we haven't, our team will obviously reach out to you individually and obviously answer those questions, as well as obviously offering you the opportunity to connect with Niall, Chris, obviously their wider team, to discuss your personal situations. But before we close, I'd just like to go around to each of our panelists and just get them to share one key takeaway from today's discussion. in terms of what the most critical actions expats should be taking to protect themselves and their wealth. So, Chris, I'm going to start with you.
Okay, great. You won't be surprised. The one thing you should be looking at is working out how long you've been outside the UK, or deciding that once you've decided to make the move, look at the options. This is an incredible opportunity to protect your wealth for your family and your estate going forward. So it's one of the most, I believe IHT is one of the most regressive taxes there is, and to have the possibility not to pay it because you're outside of the UK by choice, it's that bit of moving away for your lifestyle, and it's right for your family and it's right for everything. But once you're outside for 10 years, to be able to avoid a 40% tax on your total estate is actually, that is the one takeaway from this call. Meet with Niall, meet with myself, get that meeting in the diary, and we can start the planning, because it really is a great opportunity.
Thank you, Chris. Thank you, Paul. I haven't heard from you for a little while. Do you want to go next for your takeaway?
Yeah, I mean, this gets said quite a lot on these discussions, but mine would be, plan early, get that peace of mind and clarity. What's not good to understand where you could be going, as opposed to the wrong direction. And Portugal is a great place to spend time and live life and invest, whether that's a golden visa or some other form of investment.
Brilliant. Thank you, Paul. And Niall, I'm going to leave the sort of last word to yourself.
Yeah. Again, echoing what everyone was saying, really. Our business has been here for quite some time already. So there's people coming to Portugal already. There was and is and continues to be some tax benefits associated with and around that. But with the onset of these changes with regards to residency and how it impacts inheritance tax, it's just another opportunity really for people to take advantage of the situation, to come out here, to enjoy the lifestyle out here, and to benefit from something that we didn't ever really foresee was going to be a situation with regards to the domicile and inheritance tax rules. It's an amazing opportunity, and it really should be looked at if that's a consideration for someone.
Excellent. Thank you, Niall. And to say a big thank you to our panelists today, to Niall, to Chris, and to Paul. So obviously these changes present challenges, but ultimately they present big opportunities for UK expats in Portugal. And obviously you've heard throughout today's webinar that the key is to act early. And you can obviously secure that peace of mind and ensure that you're protected, and what you've built up is in your control. So again, we've been saying all throughout here, again, reach out to us at Portugal Pathways, and we can arrange that no obligation discovery call with Niall or Chris or their wider team, and they can obviously explore your specific situation. So just before I go, I just want to obviously thank you all, the audience, for joining us today. And obviously don't forget to join us for our next webinar in February, and that's entitled Finding the Right Place to Settle in Portugal. That's on Tuesday, the 25th of February at 4 p.m. at Lisbon time. I believe the team have put a link up if you want to register for that event. Just leaves me to say thank you once again to our panelists, and thank you to the audience. It's been a really engaging conversation today. We look forward to obviously meeting a number of you, obviously these discovery calls. If you've got any questions about anything outside of what we've discussed today with regards to your life in Portugal, your proposed life in Portugal indeed, please sort of reach out direct to myself. That's steve.philp@portugalpathways.io, or obviously reach out via our website, www.portugalpathways.io. Thanks once again. I said we'll be sending out a full summary and a replay of the video within the next 24 hours. So thank you for your time. and have a great day. Thank you.